What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is February 14th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, I want to cut straight to the chase and spend some time talking about the stock-to-flow model. I know a lot of you out there are curious as to whether or not the stock-to-flow model currently holds weight in the market, if it's still a solid data science model that we need to follow. And as we like to look at data science models here, I want to give my candid take, talking about the good and the bad. Now, I understand as well, and I just want to go ahead and address the elephant in the room, that a lot of people think that because we went against the grain back in November and December of 2021, that we were going against a lot of the kind of probables that we're calling for the super cycle, that I'm going to instantly have a negative opinion. And that's actually not the case. I really admire Plan B, admire a lot of other people out in the data science space that work tirelessly to try to build models to try to understand the crypto markets. It's no beef, no misinterpretation there. So I hope you guys understand that it's just genuinely my personal feedback that I want to share and what I think you should know about. And outside of that as well, we've got a sponsored review of Radix, one of my favorite layer 1 protocols, later on in the video. So stay tuned. You guys won't want to miss it. All right, so let's go ahead and dive into this conversation, guys. We've got the stock flow printed up here on the screen. Now, generally, for those of you who may not know the general principle of what the stock flow model is aimed at doing, is it's aimed at generally understanding that over time, we understand that Bitcoin as an asset is going to have a variation of the amount of new flow that comes out onto the market versus its existing supply. We know this because of the halving event that happens every 4 years within the Bitcoin network, where we start to see a reduction in the amount of new Bitcoin mined in each block. That's the general principle. And the theory behind this is that as the stock to flow, right, the existing stock on the market, the existing supply of Bitcoin, is starting to, in this case, become larger and larger against the new increment of Bitcoin being created. So as we're reducing the amount of new Bitcoin, and that ratio between the new minted Bitcoin and the existing supply gets bigger and bigger, right? As we're creating less and less Bitcoin, then Bitcoin's price should reflect that. It should increase over time. And that's the concept of stock to flow, or the S2F model, as it's sometimes referred to as. So the idea here is that Plan B, who created this data science model, wants to be able to find a means to be able to, through regressive analysis or through regressive techniques, be able to take existing price action from Bitcoin and other sources in order to combine that with stock to flow and get a projection about where we could see Bitcoin go within the cycle, or where price should generally track around. Now, I want to go ahead and emphasize here some of the good things about the stock to flow model. And first, what needs to be said overall. And as I emphasized at the beginning of the video, whether you like the stock to flow model or not, it really doesn't matter. That at the end of the day, no model is perfect. I'm going to say that right off the bat here. If I were to create a data science model, and I call it mixed data science model, and it could be so great, it could be right 95% of the time, or give some kind of band or range of expectations for Bitcoin's price is going to go. Either way, no model is going to probably be perfect. Models are a way to try to interpret and understand where things can go over time. All right. So just putting that out there and stuff, that's the first thing to understand. Now, what I think is really great about the stock to flow model is that even though it does use data regression, which I'm going to be talking about as one of kind of the negative flaws later on, or at least something that is important to be aware of, I have to say the overall stock to flow model has done a pretty good job of being able to give us some type of projection around where price is going to go. And outside of that, it does give us a good idea when price has gotten overheated or has become oversold. So for example, it not only starts to take into analysis when we've gotten above what's seen as kind of the fair value band here for Bitcoin according to stock to flow, or at least according to history, right? And we can see here that when we start to get exacerbated above there, when we start to get into the green range here in the sense of the days until the next halving event, right? This generally gives us a pretty good band of information here that, hey, the market might be getting overbought. And historically speaking, when we get into this blue range here, right, when we're just a couple hundred days away from the next halving, the next supposed supply shock or reduction of new supply, hey, that's historically been a pretty good time to get into the market, right? At least in the last two cycles. Now, the days until the next halving, right, have started to vary a little bit throughout the cycles, right? We can see that through time, the color scheme has changed a little bit through different parts of the cycle. But generally speaking, when we get into this red band here, this has been, again, another historical time where it's generally time to go bullish on Bitcoin. The trend is strong, we're trending up higher, and we're likely moving towards new all-time highs, right? So overall, I honestly think overall the stock to flow model, right, all the while I'm going to share my candid feedback here in a moment, it's not a terrible model. It's not the worst model out there in the cryptocurrency space. At the same time, though, I want to go ahead and provide my candid feedback on the stock to flow model. Now, I'll go ahead and say it, I'm not a data science expert at the end of the day, but it doesn't take being a data science expert to understand that the stock to flow model is not a God-given model that is going to give you the absolute answers to where Bitcoin is going. And I think one of the problems I want to address here is that there's a misconception in the crypto space. And to be honest, I think it's there's a little bit of fault to blame, and I'll talk about that later, as to how it gets touted as this kind of great model to follow, right? Now, because of its general attraction, its ability to showcase that Bitcoin does make exponential rallies over time, and I gotta be honest, design-wise, it's a very beautiful data science model. I think a lot of people fall into this trap that it is an absolute guarantee of being able to guarantee where Bitcoin's price is going. And unfortunately, I'm gonna tell you guys the truth here, and this is the reason why when we do technical analysis on Bitcoin, when we do any form of analysis, fundamental analysis, anything you can think of, no one knows exactly where things are going at any given time. We can use these models to help project where, according to history, things might go, and that plays into technical analysis just like it does in data science, right? But the key point here is that no one is going to know where things are going. And the stock to flow model does have its flaws. So let's go ahead and talk a little bit about some of those flaws. So there's a really good article here that came from Aman here. This is a contributor on Medium that had kind of broken down how the stock to flow model is made up. Now, just for the sake of time here in the video, I'm not going to dive into every single element of the stock to flow. Going into any of the data science models we talked about here on the channel would probably deserve a breakdown, a longer video breaking down how it operates. But you guys are welcome to read through this model, and he actually created a really interesting means of breaking down the steps as to how the stock to flow model is generated and generally the premise of what it's based around. Now, the one thing I do want to focus on here that I think he summarized very well is the limitations of this data science model. And that's the only thing I really want to transmit here, is that there are limitations to this model. So first off, I want to go ahead and talk here about the first key element here that we need to understand about the stock to flow. Is that while this model has worked pretty well so far, people aren't entirely convinced at the ridiculous valuations it calls for over the next few years. 288,000 by 2024. Some say that the correlation is not causation. The price mostly focusing on the model so far could have been coincidence. There could be various other factors affecting price. This leads me to talking about one of the first things I want to discuss here about the stock to flow. Now, when we take a look back at history to the stock to flow model, it's actually done a really good job so far of helping us to project where Bitcoin's price may be going. But a lot of people have been really shocked at the fact that we didn't get the super cycle back in November. We didn't see some parabolic breakout that seemed guaranteed across many of the major data science experts in the crypto space. Why could that be? Could the stock to flow model have been missing something? Well, I want to go ahead and emphasize something that's very important to understand, guys. And that is that all markets, whether it's Bitcoin or stocks or anything, you name it, it is driven by supply and demand. And you'll see this start to play out here. And this is, I think, one of the biggest flaws of the stock to flow model that we need to be aware of, and how it will have a lagging, or not per se lagging, but it's going to have a weakening amount of value proposition when it comes to analyzing Bitcoin's price. Because over time, all the while you might be reducing in half every 4 years the amount of new Bitcoin mined in each block, that amount of supply coming onto the open market is becoming less and less and less relevant, right? If you go, for example, and I just want to think about a simple analysis here. Let's say, for example, we go back a couple years in Bitcoin, right? I'm not using the official numbers here for the halving events and stuff. But if we just go ahead and use a mental model here, where we were to go from 20% annualized inflation down to 10%, and then a couple years later, we go from 1% to 0.5% of annual inflation, I want to ask you a quick question. Which one of those two events is going to have a more dramatic effect on Bitcoin's price? They're the same percentage reduction, right? But which one is going to have more of an effect? Just take a moment to think about it. The one that's going to have more of an effect is the first one. Very, very likely that it's going to have more of an effect. And the reason why is you are reducing, on a much larger degree, new supply introduction to the market, right? Now, sure, over time, right, both of those halving events reduce the same percentage decline. But if we're talking about the overall introduction of new coins, right, into the market, if you're at 1% inflation and you're going down to 0.5%, it's really a negligible effect in the market. And here's the reason. Because what matters much more at that point versus back in the past when you're going from 20 to 10% is whether or not you've got more buyers in the market or more existing holders selling their assets. And that's an important thing to keep in mind. All the while, and I talked about this, we were big proponents of talking about the stock flow model during the bull market in the early stages. It does hold relevancy towards kicking off that initial cycle, right? But at the same time, people are really stunned when they see, wow, why is the stock to flow model still hanging sideways here? Shouldn't we have just gone parabolic here in March when we were picking up pace? No, that's not always going to be the case. Especially in the market, I understand there's leverage, there's all kinds of things that we've been very much against here on this channel. We've been calling out the leverage trading platforms and people using margin to trade. That's one dynamic. But we've even seen here in the past year as well that price can sit sideways for a while. The key point here, though, is that when we come to the peak kind of flat value here of the stock to flow, when it stops to ascend over time, we've seen that the peaks have actually pushed out further, right? We can see we had a peak out beforehand. We had a peak out exactly at the neutral point here where things started to flatten out, where the stock flow model adjusts. And we had here, for example, another pushback. So one thing we were emphasizing back here during this period of time when we were raging higher, when we had the pullback in May, is that it's not some spot-on model where price is just going to fit to it. It has periods where it exacerbates above it and below it. And on top of that, over time, the cycles are taking longer, because the stock to flow doesn't hold as much relevancy anymore, right? Because the supply reductions are becoming more and more negligible than their predecessors in the past. It's a very important thing to keep in mind here, guys. And I'll give you just a great visual example of this flaw here, right? Again, just to put it really into context. Let's say, for example, we have the halving event tomorrow. That's great. That means that miners on the market that are introducing new Bitcoin are going to be selling at a max, less than half of what they were doing before, right? And that's great news, right? Or sorry, at a minimum in this case, they could only sell half of what they sold in the past. That's great news. That's going to help Bitcoin's price. But Satoshi pulls out his coins and he starts dumping on the market. You think any data science model, any halving event is going to help that? Unfortunately not. Now, of course, that's a dramatic example, but it's to showcase here how even a fraction of reduction of new Bitcoin being minted every year, the drop in the inflation rate, really holds no relevancy after some time, when the vast majority of the coins are almost coming up on 19 million out of the 21 million that will ever exist for the Bitcoin network. It starts to become towards a point where mining sell-side pressure really doesn't matter as much as existing holders. So that's one key thing here as well. Outside of this, well, a lot of people point to the fact that some arguments made against the S2F in this case are that, well, if we take a look at gold in the past and compare its stock to flow, the existing supply of gold in the market plus its annualized inflation rate, which usually sits around 1% to 2%, we don't really find much correlation in price according to the stock to flow, or any correlation between these two different metrics. So again, all the while, some chart might play out very well. It could, again, in this case, be just mere correlation rather than the causation, right? So it's an important thing to keep in mind, again, around this. And all the while, we can provide all these feedback points from the stock to flow. The biggest thing I want to go ahead and talk about, which is probably the biggest issue, and I think in hindsight, I think it is healthy to reflect. While we do here on the channel, we talk about when we get things wrong here on the channel, guys. I've made some wrong calls. I'll go ahead and read some off for you. I thought back in 2019, we were going to come up to 50K by the end of the year, I think in 2020 or something. Back in the couple of past years, I've made some terrible calls, right? And I'll be the first one to admit it. What I don't like seeing is in the crypto space, when we have a model that is starting to showcase weakness, that we continue to preach it as if it's gone home, we bet our cards in it, we can't admit that it was going wrong. And that was the problem that I saw back in November, and why I was so confident in making my call that we were not going to reach 100K by the end of the year. There was too many people confident that this was just absolutely going to happen. And we can see here the kind of, not in a sense, and I don't mean this as rude to be rude to Plan B, but he holds a major platform to not go out there and confidently state that We're still betting on it here. Like, just because one day it stepped out of the model here, that it's absolutely failed. And to be honest, there was a lot of statements he had made and in retrospect that were too confident on the model, where like, if this happens, then it is invalidated, right? And he even commented later on that, yeah, I shouldn't have said that. And totally props given on that and stuff. I appreciate that. That's the kind of self-reflection we need in the space when it comes to crypto. Whether you're a data science expert, whether you're a YouTuber, whether you're a personality on Twitter who's trying to time market and trade, no matter who you are, it's important to step back and call when you get things right, but also when you call when you get things wrong. And again, one thing I wanted to give as a major props to the stock to flow model, even though, again, we'll get to my major final point here, is that overall, even though, again, I think the way that it's interpreted by the mainstream, it didn't play out to its favor. The 4-year cycle that everyone was calling for didn't play out. At the same time, I don't think it's really invalidated here. Again, we're just having an expanding top here that's going to come in later on, much longer than many people were thinking about back a couple months ago. And the biggest point here that, again, you need to understand here when it comes to the stock to flow model is that it utilizes basically regression analysis. Okay, now to put it very simple, regression analysis basically means that as new data points come in, right, new days and price points for Bitcoin come in, the stock to flow is going to adjust. So one thing that I think is very important to understand is that these levels here change over time. Some of you might have not noticed that. This line here, this core stock to flow line, changes over time, as it's taking in new block data and new price information of both the stock to flow, right, the daily changes in the stock to flow, and that's why sometimes it can vary. And outside of that as well, the price action, right? Now this line here used to sit around, if I remember correctly, somewhere around like the $90-something thousand range. It was a little bit more optimistic. Right now it's sitting more around $70,000 to $80,000. It slightly ascends over time, right? So again, really important point to keep in mind here is that this model is actively changing. It's not just the price being laid over it. We have the actual stock to flow model, the line itself, changing over time. That's a very important thing to understand. But my biggest point I want to go ahead and talk about is to build on top of the stock to flow model and explain my thesis for how I use it for analysis. My understanding is when I use the stock to flow model, I still use it amongst many other data science models, right? So hopefully that just clears the air in the room in this case, that I really do like the stock to flow. I think it makes sense. There is a supply reduction, and that is going to help bolster price, and it has been a good catalyst for the previous cycles. My major point, though, that I want to talk about is why we focused and emphasized so much on the expanding cycles versus what Plan B and many others promoted, which was the 4-year cycle. The 4-year cycle not only has its flaws because of the sheer fact that there wasn't a 4-year cycle for the first cycle that people claimed. That just wasn't true. There was price action being included that didn't exist for the 4-year cycle. But outside of that as well, if we take a look at history in the previous 3 cycles, right, from bottom to top, which is how we like to analyze cycles, we can see a very interesting trend. That generally speaking, each and every time we add around 11 to 13 months. Went from 11 months to 24 months, 24 months to 35 months. That generally gives us a year expansion from bottom to top, which is, I think, what we really care about. We want to buy when we're at a discount, right? When we're at that 80-90% correction range. We want to know how long it's going to take before we get that parabolic blow off top and really are able to walk away from the table with some great profits, right? And that's exactly, I think, what we saw here. And what we're seeing here within price. We've been gun-ho on this idea of a November 2022 top. It could be October, it could be December. I'm not here to call the absolute top or day of the top. But I think what we've been going through is just a long sideways consolidation period, still setting in those higher significant lows over time, setting up the foundation, showcasing that the bulls are still in the charge here, that this isn't a bear market, and that it's going to take longer than people estimated. We were calling this back in November, even as we were back here at the November range where price was really optimistic. It had hit new all-time highs again. We drilled this point that time frames generally are going to take longer with each and every cycle. So I've rambled on enough, guys. I hope more than anything this comes across as a neutral take here. Again, I think that it can be a useful model, but it is not a godsend. There is no data science model that's going to tell you everything about price. And it's important for all of us, including myself, to keep ourselves in check from time to time, to realize when sometimes we get too confident in something, right? I think it's responsible and incumbent on all of us in the crypto space, not just people like ourselves, like Plan B or Willy Woo, or myself as a YouTube creator or any other content creator out there, right? It's not only important for us to keep ourselves in check, but also the investors yourselves. We need to not trust any key source as the ultimatum for information. We need to go out and do our own due diligence. We need to keep as rational, and more importantly, keep more rational than the crowd, because in a lot of cases, the crowd can be irrational when it comes to finance, because many are thinking with their emotions and are betting on the bets that they've already placed. So anyways, that's it for today's video, guys. Sorry for rambling. Let's go ahead and dive into this review of the Radix protocol. Alrighty, everyone. So for today's sponsored review, we're going to be taking a look over a protocol that is a familiar name here on the channel. It's no other than Radix DLT, or the Radix protocol. Now, for those of you who haven't heard about Radix, Radix is aiming to revolutionize and change the way that DeFi is done. It's aiming to build a network that's not only much more scalable to be able to provide the throughput that we need for widespread adoption of decentralized finance, but outside of that as well, they really focus in on trying to streamline the time for developers to deploy applications and provide a language and framework that's going to provide the security needed to store billions, if not trillions of dollars of funds going forward into the future. Really big picture stuff. So as you all know, Radix is one of my favorite layer 1 protocols, but outside of talking about the fundamentals that make me really excited about it, I do want to spend some time to talk about why developers should get excited about it. If any of you happen to be Rust developers eager to get into the cryptocurrency space, or maybe are familiar with other language frameworks and are eager to get into the next big protocol, I feel like Radix might be something you want to keep on your radar. Whether or not you're a developer, if you're not a developer like myself, I found a lot of keen interest in Radix, but a lot of the people that I follow out there who are developers and are people who are looking for interesting new protocols and implementations of building DeFi applications, Radix has definitely been on the radar. So let's go ahead and just first talk a little bit about what Radix has to offer. If you guys are interested, I definitely recommend checking out, going beyond what I just say here on the channel and checking out the developer section of Radix. They've got a lot of great documentation. Scripto, which is the language we're going to be talking about that Radix utilizes in order to actually build DeFi applications. All the information around Scripto is there and a lot of great resources to dive into. But I want to go ahead and talk a little bit about Scripto. So as I hinted to earlier, Scripto is a per se a modification or an implementation of Rust for the network in order to actually build applications. But it's important to understand here that unlike Solidity, which is the native language of Ethereum, there's a different orientation in this case as to how things are actually executed on chain within the Radix engine, right? Just like how you have the Ethereum virtual machine, you have the Radix engine where applications are actually deployed and utilized. But it's important to understand the big key difference here as you're diving through and learning about Radix, and that is the fact that its assets are native first-class citizens. This is a bit different than what you find with traditional blockchain networks. It's a completely different framework of how assets interact on chain, and also as well how applications or smart contracts interact on chain. So understanding the key difference between these two elements is very important before you go about building in this case. And this is something, again, not only if you're an engineer, but also as a key investor in the protocol, you should understand these types of things, right? It's very important to do your due diligence and understand the difference between these two factors, right? But one thing that I think really will start to showcase here why Scripto is such a game changer here, even if you're not a developer, is to understand the dramatic simplification that it can bring. We first need to understand the problem at hand in order before we can see that. So first off, let's take a look here. There's a really good article they put out back in October talking about the problems with smart contracts in today's world. So you can take, for example, and I'll be honest with you guys, it is still to this day one of my favorite applications on Ethereum, and that is no other than Uniswap. And a more fancy term for it is automated market makers, protocols that allow you to swap from one token to another in a very streamlined way. You don't need another pair trader. You're just able to swap from one token to another through liquidity pools or LPs, right? Now, ideally, when we take a look at smart contracts in today's world, we probably think, with Uniswap, what happens behind the scenes is what we see. Right? We see in this case that I'm sending one token to the smart contract, and I'm ideally getting back another token, the token that I'm opting to swap for, back to my wallet address. And that is how Uniswap sort of feels at the end of the day. When in reality, and this is again a very kind simplification here of what happens on the Ethereum network, but this is much more likely what we're seeing when we actually trade on Uniswap. Seems a little bit complex, right? And the problem with this is we're utilizing a language like Solidity that's been around for some time. And if we're not only taking a look back on it, we have to look at it in a candid way, right? All the while Solidity has helped leapfrog Ethereum to being the largest blockchain out there, it is not due to Solidity itself. Ethereum was one of the early stage networks out there, and Solidity being an implementation of JavaScript, right? It's a pretty popular language to some degree. Rust as well is getting a lot of traction. And because of that, Scripto not only aims to benefit from the simplicity of Rust as a language and the streamlined capabilities that it offers, but it is going to allow us to build a similar application to many apps like Uniswap in a much more dramatically simplified way, saving engineers time, bolstering security, and making sure that DeFi applications, similar to the ones we've already seen, but also ones that we haven't seen to this day, are built in a way that we can bet on, that are time-tested for the going preceding decade. So I want to go ahead and just talk about this in full steam, right? Now, it's one thing to showcase the graph here, right, and to dive through, and you can dive through the documentation understanding how they can simplify this, but there's no better way to do it than to dive simply through the code here. So we can see here Russell from the Radix team, who's one of the technical leads on the project, came out and did a really awesome video here showcasing how you're able to take the original Uniswap code base, right, from Uniswap v2, it's open source, it's accessible for everyone. You're able to take that, which is written in Solidity, and within the Scripto language, break it down multiple folds less than what it previously took to do on Ethereum. The amount of functions, the amount of different types of code that you have to basically put into actually making it happen is dramatically simplified. And I don't remember the exact number here, but I think the total amount of lines of code in order to actually execute and allow the functionality that you use to on Uniswap to be able to swap from one token to another, to provide liquidity, is just practically, I think, anywhere from like 100 to like 300 lines of code versus Uniswap, which gets into the thousands of lines of code, right? So again, you're dramatically simplifying not only the developer experience, but you're also simplifying and securing the ability to make sure that all these actions that are interactable with the protocol don't lead to vulnerabilities, they don't lead to smart contract exploits that hackers or manipulators might be able to utilize to their advantage. Now, if you guys are really interested to dive in deep, I recommend diving into the new DeFi white paper. They routinely keep these white papers updated. They just did an update back in January. And one of the things that I think is really cool here, and we'll see as kind of a driving point here for Radix, is that you tend to find that a lot of the layer one protocols out there that are emerging to kind of compete with Ethereum, they're always focusing on one trend to the next. They're focusing on the metaverse and NFTs and this and that. And to be honest with you all the while Radix has definitely made its changes over the past couple of years. Radix has been around for a long period of time, and it has set in stone a major focus point on DeFi, which I personally really resonate with. Now, it's not to say you couldn't deploy NFTs, you couldn't build metaverse projects and all the other great stuff out there, but as a protocol, they really have a clear market focus of DeFi and building the Lego bricks here to be able to actually build that foundation so applications can thrive. And they believe that this is the market opportunity. Although while DeFi may not be the hottest trend this moment, they're focused on a long-term set of objectives. Their roadmap is focused on dropping major releases that will eventually allow us to see the benefits of Scripto in full swing and have it live and deployed on the mainnet. Right? So this is a really, really interesting thing. I think the vision long-term is right set in stone with what I believe in, which is that we need to be able to build DeFi, not just for this kind of enclosed world that we're in right now, where we're swapping one token to another, we're lending crypto assets to earn interest, or using crypto collateral to borrow more, stable coins, or other types of cryptos. I think what Radix is building here, and this is why it's important to focus on its long-term vision, is that it really has the grounds here as a potential layer one competitor to be able to stand out in building a vision where you're able to build applications that we haven't even seen yet, that are really going to tap into the real world, that are really going to start to expand out. Now, it's not something we're going to see here in a couple of weeks' time or a couple of months. It's going to be a couple of years, and the Radix team and the community are around that vision, that it's going to take time to get to where we want to see Radix grow to. But the important thing that they get right is having the developer language in order to expedite the process of getting there. That's a very, very important thing. And you guys know firsthand, I'm a big Ethereum fan, but there's too many vulnerabilities in Solidity smart contracts on a routine basis. There's too many ways where malicious hackers have been able to break through and utilize vulnerabilities in Solidity, which again, have left Ethereum in a position where there's just so much catastrophe for the end users and little to no recourse to protect them. Now, I wanted to go ahead and share one thing which I think just kind of sets the stage here for the CES 2022 conference. Here's some photos of Radix attending there. And you can see there's some pretty solid crowds around the booth here. A lot of people interested, I think, in what Radix has to offer and the vision of Scripto as a language here when it comes to programmability for this emerging layer 1 blockchain. So I definitely recommend you guys take a look through Radix here. The big thing I want to emphasize though is if you're really just looking for like a quick pitch as to why Radix may deserve your attention, I understand there's a ton of stuff out there in the crypto space, guys. It's sometimes hard to shift through the noise. One of the things that I use when I do my due diligence is just trying to get like the quick pitch on like what it is the protocol wants to do, why is it different, and why is it going to win out in the long term, right? Whether I'm investing, whether I want to contribute to something, I always have those questions on my mind because you got to be that way, right? Your time and attention is very important. So what I always recommend is diving into this video. It's called How We Will Win with DeFi Developers. It's a video from the Chief Product Officer over at Radix and basically summarizes very candidly why Radix is a protocol, what its vision is, what it is, and why it will stand out against the test of time for developers entering the crypto space. There's a lot of barriers to entry when it comes to learning Solidity. I mean, there's a lot of resources out there you can go out and learn about it. But the problem is that when you're going about building contracts, in this case, in Solidity, the problem is that this is not software where, for example, I had a bug in the code and it led to this kind of this visual element on my application crashing or something like that, right? You can have front-end bugs, but you cannot, and I repeat, you cannot have bugs when it comes to Solidity smart contracts where the real functions are happening, where the real money is moving, because that's people's money, right? I mean, again, I don't mean to sound all like too dramatic or melodramatic, but it's the truth, right? We need to make sure that people understand here that this is real money. It is real actions that are able to be taken when we deploy a smart contract. So I really recommend diving into this and how Radix plans to stand out in the sense of bolstering security and more users to the platform. And if anything, if you guys are not sold on potentially learning more about being a developer, go and ask some questions if you have any in the developer Radix Telegram. I can't tell you guys how many layer 1 protocols I've seen that have huge telegrams, but they don't have one for developers to be able to reach out, communicate with one another. And this, again, alongside the roadmap, the professionality of the team. For example, the recent Jepsen report that Radix had worked on with Jepsen, which is doing an audit or basically review of the Radix engine, Scripto. I have to say, overall, to me, is incredibly exciting. The professionality of the project is what stands out above all. And where so many projects are looking to be on the next hottest trend, Radix has been time tested. It was founded and really grew back during the bear market of 2018 when I got to meet Pierce and a couple other members of the team. I've seen how the protocol's grown, and it's so nice to see that their vision is finally coming to life. But I digress, guys. I know I've rambled on enough today with what we were talking about, the stopped flow model and what we've been talking about here with Radix. If you guys enjoyed this video, consider dropping a like. As always, one of the best ways you guys can support the channel. And if you're interested, consider subscribing and hitting that bell icon so you don't miss another upload here on the channel. But if you guys are interested in a little more about Radix, check out the links down below in the description. Until the next video, I'll see you all in the next one. Take care, everyone.